All right, welcome to lesson 3. In this lesson, we're going to be understanding crypto technicals. So we're going to be understanding everything on the technical side. So technical analysis, technical terms, anything technical about cryptocurrency, we are going to be learning in this lesson. So make sure that you're taking notes specifically on this one and run through this module a couple times because this is very important if you don't have much trading experience, especially doing technical analysis and implementing trading strategies onto an actual crypto chart with placing orders and actually using trading tools. So that's what we're going to be learning in this module. We're going to learn how to use trading tools. We're going to learn about indicators. We're going to learn about technical analysis. So stay tuned because this is an important module. All right, so now we're going to take a dive into crypto technicals. So we're going to understand crypto on a technical level. This means we're going to be learning the technical side of the house. So you learn to read, evaluate, plan, and execute trades and trading functions on a crypto chart. You'll learn all about indicators, tools, and crypto on a technical level. We're also going to learn mastering technical analysis and exactly the things you need in order to be able to trade and understand how to read charts. All right, so next we're going to talk about candlesticks. So basically candlesticks are a visual representation of overall price movement for that period of time. So they're sectioned off into time increments showing net positive or negative change, and they're also showing you the highs and lows of that price range. Okay, so we have green candles and then we have red candles. Green candles have made a net positive change and red candles have made a net negative change over that period of time. So if we look at a green candle right here, green equals close higher than open. So that means that the open price was right here on this line. The lowest the price has gone for that period of time is this lower wick. The close price for the entire period of time, meaning that that's where this candle closed at in order to start a new increment of time, is closing right there. And then we have the high price as well. On a red candle, we still have the whiskers signifying the high and the low of this price duration. But since it's red, it's showing a net negative. So it's opening up at this portion and then closing at this level, making it red. So that's how you kind of read candlesticks on charts. Each increment of time is represented by a candlestick, and then the net change is represented by the color. The high and low is represented by the wick. And that's basically how you read a candlestick. That rhymed. Okay, so a trend. So a trend is a group of candlesticks essentially. So it's basically a group of price movement showing us an average direction of price movement. So basically the way we can signify trends is by looking at highs and lows and seeing how they relate to one another in respect to where they're positioned. So an uptrend is when the highs are consistently making higher highs and the lows are consistently making higher lows. So basically, if our lows are constantly getting higher and our highs are also constantly getting higher, that means that we now have an established uptrend. And as soon as that changes, that's going to be a trend reversal, right? So we have outer parameters of the trend following the outsides, basically following the lows. And then we have the trend channel on the top following the highs of the trend. So we have a downtrend now, and this is the same thing but in the opposite direction. So a downtrend is when the highs are consistently making lower highs and the lows are making lower lows. So we have a high here, a low here, a high here, a low here. These highs are gradually getting lower and the lows are also getting lower. That signifies a downtrend to us. We can also see the outside channels of the downtrend. This is showing us the range of the highest area on this trend, showing us the full stretch of the width of this trend, and this is doing the same thing on the lower end. So this kind of gives us an idea of where the trading channel should be. Now we're going to talk about support and resistance. So you might have heard support or resistance be used in trading lingo or technical analysis. So basically support and resistance mean similar things but are talking about a difference in where the pressure, the buy or sell pressure is coming from. So support is referring to the price being held up and resistance is referring to the price being held down. So support is lifting up, resistance is pushing down. And we can see right here we have a wide range of movement and we're having support areas right here and resistance areas right here. And we can see that by where the price is starting to change direction and showing us basically invisible lines where the price is bouncing off of. If we have a trend break, we can see our lows here, our lows here. We have a few highs up here, and then we have a low established here, and then the low breaks down through that range into another downtrend, which is going to be a trend reversal. Next thing we're going to talk about is symmetrical triangles. This is the way price action can move. So the candles can move in this direction in order to break out of ranges and break out of supply and demand imbalances in certain predictable patterns. Now, we don't use this in the InnevaTrade system, but I think it's very important to understand these general patterns so that you can look at charts and understand if things are going to move up drastically or not. Okay, so this is called a symmetrical triangle. This is where we have positive price action coming here, turn negative, and basically funnel into even lows and highs coming to a focal point where the trend has to resume in a certain direction. Whether that be down, whether that be up, depends on where there is more buying or selling pressure. Okay, so here's a real life example of this pattern. So we have a range break right here, a high established, a low established, and then it basically weaves in between these lines right here until it hits the focal point and decides that there's more buying pressure than selling pressure, and it breaks out of that upper trend. The next pattern I'm going to talk about is ascending triangular breakout. So basically that's when the price action moves up, comes down, moves up again, but we have the ascending lows right here with a horizontal neckline breakout level. This means that there's a resistance level coming from up here, and there's a solid straight line basically telling the price that there's no need for it to break through that level based on the supply and demand. And we have the demand increasing slowly on this lower trend, saying that this has to come to a point and make a decision. And if it breaks out, it means that there's more buying pressure than there is pressure holding it down. So same thing with a descending triangular breakout. We have the price action moving down to a horizontal neckline support level. Support because now the price is being held up. Now we have the price moving up to these descending highs over here, consolidating down and then breaking down through the neckline support if there is more sell pressure than buy pressure to hold it up. The next indicator I'm going to talk about is Fibonacci, and I'm going to get into this a lot more in the course and when we start looking at charts itself. I want to explain to you what Fibonacci is and how we use it in trading rather. So Fibonacci is a naturally occurring ratio that uses the study of mass human psychology in order to predict reversal points. So basically we can use this to look at levels where the price action is likely to bounce off of. Therefore, we can use it as important key levels for when we're trading. So if we look at this indicator right here, we click and drag on this low and drag up to the high of a trend, and it shows us areas where the price is going to likely bounce at after it pulls back and retraces. So the 0 level right here is the top of the trend where you put the high of the retracement tool. The 50 level is the halfway down the retracement. This is a very strong bounce level for a trend that is going to continue moving high on the initial move. The 61.8 level, or the golden ratio, is a full retracement, and in the study of Fibonacci, the 61.8 is the magic number where we see pullbacks and then continuations. So this is a potential reversal level where there is a new bullish trend that will likely form in the movement, will continue upward. And then the 1 level is the lowest point where the trend you are evaluating has moved. So this is going to be the low of the trend. This is considered the 1 level, basically like the home base. So I want to show you using a Fibonacci on a crypto chart. So essentially, let's look at this trend right here. So I'm going to click the low of this Fibonacci tool down here, and the high is going to go up to the high on this trend, which is right here, a low here, and then we have a high up here. So that's where we want to put our two elements on the Fibonacci, and you can see right here we have a level where the price is reacting off of this level right here. We want to just start to look at different levels where the price seems to be reacting with the Fibonacci in order to confirm that we actually have a legitimate Fibonacci placement, so we can then further evaluate the technical analysis. So you can see there's a decent amount of levels where the Fibonacci seems to be reacting with the price action, or the price action seems to be reacting with the Fibonacci. So this is essentially how you use a Fibonacci retracement tool. Here are all our levels that we talked about before. You basically, if we want to do this one more time, I can remove this from the low right here. Sorry, that's the wrong tool. That's the wrong tool, bruh. So we're going to click the low right here and then drag and place the 0 level on the high right here, and that's how you use a Fibonacci Fibonacci retracement tool. We'll get more into that as the course progresses. Next thing I'm going to talk about is a simple moving average and an exponential moving average. So a simple moving average is an arithmetic movement average calculated by adding recent close prices and then dividing that by the number of time periods in the calculation. So basically, if you take 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 candles, call it 10 for sake of example, and you have a average movement up and down of all these candles, you're going to take the average movement of all these candles and divide by the total amount of candles, and that's going to project your simple moving average. Now we also have something called an exponential moving average. So an exponential moving average is a weighted moving average that gives more weight or importance to recent price data than the simple moving average does. So same thing as before, but basically what the exponential moving average is doing is it's higher weighting the importance of the movement that is most recent to this trend than it is the data all the way at the end. So like this price action down here closer towards the current price is going to be weighted into the calculation of the exponential moving average more than the data way back at the beginning of the period. So it's going to kind of give you a more short-term reading of what the movement is doing. That's why we use exponential moving averages with simple moving averages, and when people see crosses, they see short-term temporary price change for an overall moving average. Next thing I want to talk about is VWAP. VWAP stands for volume weighted average price. It's a trading benchmark used by traders that gives average price a security has traded throughout the day based on both volume and price. It is important because it provides traders with insight into both the trend and the value of the security. So the volume weighted average price, VWAP, appears on a single line, or appears as a single line on an intraday chart, 1 minute, 15 minute, and so on, similar to how moving averages look. Retail and professional traders use VWAP as a part of their trading rules for determining intraday trends. VWAP only works on an intraday level. If you try to use it on like a larger time scale, it's not going to work because it's basically a day trading it's a day trading tool. So you don't want to try to use VWAP on long-term investing because it's really showing market participation and support and resistance levels based on price and volume for that day. But VWAP is a very important indicator that we do utilize in our stock trading more so, but I just figured it's an important indicator to know overall. Next thing we're going to talk about is chart frequencies, and we touched upon this when we were talking about candles, but I want to dive into that a little bit more in case people aren't quite sure what chart frequencies stand for. So each candle you see right here is representing an increment of time. So if this is a 1 hour chart, that means that each candle is representing 1 hour of price movement with a low, a high, an open, and then a close price. So we have 1 hour candle right here. This is one candle that represents an hour. Okay, then we have this 1 hour candle basically equaling 4 15-minute candles on a 15-minute chart. So if you have an hour chart, one candle is representing an hour worth of price movement. If you take that exact same chart and flip to a 15-minute frequency, you're going to have 4 times the amount of candles representing the same price action in a smaller increment of time. That's why we use different trading frequencies based on our strategy and how quickly we want the results of the trade. So if you're trading on a daily chart, most likely you're going to be waiting several weeks to a month for your trade idea to actually work out. If you're using a 1 minute chart, likely you're going to be entering and exiting within the same day because there's going to be major moves because each candle is representing the same data but with more candles. So here's an example on an actual chart. This is a Disney chart. Just bear with me. This is stocks, but you can use the same thing for crypto. It's applicable across. So in this box right here, we have all 5-minute candles. And if you can look right here, all of this price data is represented the same thing in both pictures. But the only difference is this is in 1 hour candles and this is in 5-minute candles. So we can see like a ton of candles over here and just a few candles over here. That's because each candle is representing 1 hour of movement over here, and each candle over here is representing 5 minutes worth of price movement over there. So that's the difference between and frequencies, and we like to use frequencies in conjunction with one another to get an overall perspective of what the cryptocurrency is doing, and then a more zoomed in, narrow, short-term view of what the cryptocurrency is doing. Next thing I'm going to talk about is RSI. So the Relative Strength Index is a momentum indicator used in technical analysis that measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a stock or other asset like cryptocurrency. We can see right here when the stochastic goes down below 30, that is in underbought territory or oversold territory. And then we have areas where it's peaking over 70, which is considered to be overbought territory. And this is used for mostly investing because if you start to zoom too in on a frequency, it stops being effective. That's what I've noticed. So RSI is kind of like an overall long-term indicator that can be used to show overbought or oversold territories. Next indicator I want to talk about is MACD. So it stands for Moving Average Convergent Divergent. And essentially what MACD is it's two moving averages. It's a EMA 26 period and then a 12 period EMA. And basically it's a short-term and a long-term EMA, and they're represented on the same sort of histograph. And when the short-term crosses through the long-term, that means that there's going to be a significant change in direction. So we can see right here, we have the blue line looping up, and then we have it cut through the red line, which is showing a short-term trajectory for the stock. And you can see as presented, we have a major sell-off on Bitcoin USD. MACD showing us where there's a temporary change in direction. So now I just kind of want to go over all the indicators that we just learned about and just kind of make sure that we have a full grasp on all of those concepts in a real applicable actual chart, so that we're not just like theoretically doing it, we can actually take a look at it. So in the case of Cardano right here, we're looking at two different types of candles. If you look over here, this is on a daily frequency, meaning that each candle is representing 1 day of full price movement. So since this candle is black, I have my orange candles representing net negative candles and the black and white ones signifying net positive. So that means that we have our open price here, our close price here, and our high here, and our low here. And then on a red candle, we have our open here, close here, low here, and high here. So that's just basically talking about candlesticks. Now I want to talk about showing actual trend lines. So I know we talked about uptrends. So right here, we can see a clear uptrend established by these lows right here. So we can click on the trend tool over here on TradingView, which is honestly the best way to chart cryptocurrencies if you're wondering. It's also free to use. So essentially you click from one end to the other, and now we can see along these lows right here, we have the price bouncing off of this sort of like invisible wall. And so that's where we kind of want to start drawing trends and establishing where we see trend lines. We'll get more into that in relation to supply and demand a little bit later in the course. But for right now, this is kind of what you want to look at to establish highs and lows of a trend and picture support and resistance. So we have support here because it's pushing up, it's holding the price up. And we have resistance along this top line right here because it's what's suppressing the price and pulling it back down. So you always have support and resistance on a trend. Support's holding up, resistance holding down. Let's see if we can find an example of a triangular breakout. So we see these highs right here going down into a descending pattern right here. And then we have these ascending lows right here. So as soon as Cardano hit this sort of focal point and the buying pressure seemed to outpass the selling pressure, we broke out of this trend, broke down a little bit, and then actually had a massive breakout. But this is an example of that triangular breakout pattern that we were talking about. Now, if we want to talk about the neckline breakout pattern, we can see right here we had a neckline resistance level sitting right about here on these points on the chart right here. So I'll circle them for us. Then we also have these ascending lows right here along this trend, and this is going to be our triangular breakout right here. Or actually, this is going to be like our wedge breakout because we have the horizontal and then we have the ascending lows right here. So we have the horizontal neckline resistance right here, the lows getting higher and higher, and then we have the buying pressure exceed the resistance and breakout. I know I kind of used the Fibonacci already, but I want to use the Fibonacci tool on here. So basically, if we have the low of the trend right here and the high so far, we can see where the price levels are starting to react off of this Fibonacci. So like if I had to guess where this price would start to top out on, I can actually drag this up until I start to see price levels reacting with the Fibonacci. So like what I like to see is that and that. So if you look right here, we can see the price actions reacting with that level right there and with this level right here. Those are two ones that are hitting absolutely perfectly right now. And then we have a few minor ones where it's not really doing too much, but we have a little range in here where it's starting to react pretty nicely off of that Fibonacci as well. So if I had to guess, and I don't know if this is true, but if I had to guess, this would be where I would start to see the price come up to here and then a little bit revert a little bit down to this trend and maybe have a pullback. So that's how we use Fibonacci. We can add a simple moving average now. So we can go over to our indicators right here and hit simple, I believe, simple moving average right here. That will add a bunch of simple moving averages. Now we need to just go into over here and we can actually turn off the ones that we don't want. So like, let's just leave like a few because this is absolutely insane. So we have, let's just keep one. So we have a simple moving average and we have inputs. So this is a SMA 20. This is taking 20 days of a period of time and basically getting the average of that and plotting it on a line. So that's how you add one to your chart. This is kind of showing us the lower end of the 20-day SMA. And yeah, that's just a simple moving average for you. I don't use them to trade, but I figured it's important. Same thing with VWAP. We can go in here and type in VWAP. Click that. It's pretty simple. VWAP should only show up on a smaller frequency. So yeah, you can see it doesn't show up on a daily, but then we go into a 15-minute frequency. We can start to see that evaluating on an intraday level. So that's kind of where that happens. As I just showed you right here, we just switch between chart frequencies. So like let's, for example, let's spread this out a little bit so we can see better. So let's take this period of time from this spike. So we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. Call it 20-ish candles inside this circle. Now, as soon as we switch to a daily frequency and we zoom all the way in, we can't even see that that's not even enough data to fit into one day. So now we go over to a 1 hour. Now we have 1, 2, 3, 4, 5 candles in here. This is the same circle. Then we go over to a 15-minute and we have more candles. And that's just showing you the difference between chart frequencies and how we kind of comprehend the same data, but just on different frequencies. So next we can add an RSI. So this is going to add an RSI down here. We have our 30 and 70 levels right here. So we can see Cardano at this point in the RSI was overbought considered right here. We see overbought territory. We do have a little bit of a pullback. We also have an overbought area right here, followed by a nice little pullback. And then we have underbought right here. You can see right here. And then we actually did have a little bit of a lift off on Cardano when it was considered under bought or oversold. So that's kind of how an RSI works. I'm going to get rid of RSI. And then MACD, I always keep on my chart. So you can see right here, as we see the convergent and divergent lines intersecting, we have a major shift in price direction on Cardano. And I know we covered bid and ask on the fundamental side, but I want to talk about bid and ask now on an actual stock chart. So when we're seeing the price move, we're going to see a bid price and an ask price. And these levels are establishing where the buyers and sellers are. So like I said, if you want to buy, you have to buy on the ask and sell on the bid. And if you want to short, you have to short on the bid and cover on the ask. So you're always going to kind of be put behind. It's kind of a way to remember if you have an issue remembering these. If you're longing a stock, of course, you can't long at the bid and sell at the ask because you'd be basically instantly making money as soon as you can click the buttons. So in order for that to make sense, you'd have to be longing here to get out here because you're automatically going to be put at a loss even entering the market. So the next thing we're going to talk about is the most active times in the crypto market. So 4 p.m. UTC is the most active time to trade, which is 11 a.m. New York City time or Boston time. So if you're looking for the most volume or move in the crypto market, we're going to see that at 11 a.m. Eastern Standard Time. That is why I tend to try to take my trades at that time, but I'm constantly setting trades up in the crypto market. But this is the most active time if you're looking for the most volume. Next thing we're going to go over are different order types, and this is actually very important when we're actually getting into trades because it's dependent on liquidity in certain instances. So there's different types of ways to get into cryptocurrencies when you're taking trades. So the first way is a limit order, and limit orders will submit your order to only get filled at one specific price. So this is the type of order that you use when you say, I want to get in exactly at this price and I don't want to get filled at any other price. So if you say I want to buy Bitcoin at $100 per coin, you put a limit order at exactly $100. And if Bitcoin hits, let's say Bitcoin really quickly goes through 100 and goes to 101, and there's not enough people on the opposite side of your trade to fulfill that order, you can get partially filled or not filled at all if it skips through your limit, but you won't get a fill in a bad spot. So it's basically an exact order where you want to get filled, but it doesn't guarantee you that you get in. A market order is basically submitting your order to whatever the market is currently trading at. So if the spread opens up and the bid and ask depending on the side of the trade you're on goes crazy, you will get in at whatever the spread is when you hit the button, which will get you in and out quickly but not very accurately. So if you have a really wide spread like that example we talked about and you just hit a market order, if you're trying to buy, it's going to immediately get you in just right wherever the ask is. And so if the spread is huge and opens up, you can get absolutely annihilated on the spread. It's called slippage. So market orders will get you in and out very quickly. And if the spread is tight, meaning that the liquidity is good and there's a lot of people on either side of the trade, market orders are usually no problem. So for Bitcoin, the liquidity is usually pretty good. Market orders are fine. Depending on what coin you're trading, market orders will only be applicable if the spread is tight enough and there's enough liquidity to fulfill that order. Next thing we're going to talk about are stops. So a stop order will submit your order to close out a position at market price as soon as desired level is hit. So basically, if you set a stop order, it's a market order at a certain price. So let's say you buy Bitcoin at 100, right? And you want to make sure that you get out of Bitcoin if it drops down to $99. As soon as the price drops down to $99, you're going to activate market order to get out of your position at whatever the market is willing to give you after that triggered price. Stop orders are meant to get you out completely at market at a desired price. A range order is a bracket order. So basically, it's a limit order that has pre-inserted stop losses and profit targets. So when you submit the order, your stop and profit target will populate simultaneously. So I can actually show you an example of doing this on TradingView right now. We'll just do it. I think there's no broker hooked up to this, so we'll just hook it up to paper just to do this example real quick. Okay, so now we have it hooked up. And we are going to, and let's say we want to buy Ethereum basically right now with a stop loss at 16 and a profit target at 1760. We can literally go into here and say, okay, I want to buy, we're on a limit order. So we click limit right here and we want to buy 10 coins, check right here, check right here. We want to have our take profit at 1760, like we said, and our stop loss at 16. We type in that. This is now a range order. So basically, as soon as I were to hit buy, boom, we have place the order right here, and then we have our stop loss down here. We can now move this range order, but it's automatically populated. But yeah, that's how you essentially use a range order. Market order is going to be the same thing, only you're basically getting in at market, and you can also have a range order added to your market order, but you're just going to get in at whatever price it currently is at. And then a stop order is obviously going to be the same exact thing where it's a market order triggered at a certain price. So it's kind of like if you don't want to have your order get missed and you don't want the price to skip through your order, you can put a stop order. So it'll basically just market you in after a certain desired price.